Hi, welcome to week one of Beyond Money with me, David Hole, Money Coach. This is a brand new YouTube series where I sit down with experts to tackle the big questions around personal finance so that you can take control of your money with confidence. We've got some great guests, some great subjects, and I can't wait to share these with you. Okay, so hi James, nice to see you.
Good to see you again, David.
Welcome to the world of David Hole, Money Coach, and thank you for agreeing to come in
Glad to be here.
Have a general chat about mortgages for my YouTube channel. So is it probably a good idea if you just give a brief introduction to you and how you work and who you work with and people?
Yeah, of course. I mean, I've been a mortgage broker now 17 years, started in 2008 in the middle of the credit crunch, raised a few eyebrows that did that. But most recently, for the last 12, 13 years, I've been working with an independent mortgage brokerage in Dorset called Oakwood. And we're most recently based at Bournemouth Airport, and I deal with a whole range of clients. So it could be landlords, people looking to move home, sadly people breaking up and going off on their own and doing their own thing, first-time buyers as well. So I help a large range of people. Okay. And that's what I'm passionate about, really, making a difference to these people and trying to save them money.
Okay. Well, as you know, you've helped me over the years with my own sort of mortgages and lots of my family and lots of my friends and clients. So, we've got to know each other quite well over the years. And you've always done a sterling job and done a good job for my clients.
Thank
you. Happy to sort of have this conversation and just sort of share an update really on what mortgages look like in this sort of current market. So we were just chatting before we started filming that probably out of all of the conversations that I have with people for my YouTube channel, yours is the most sort of topical from the point of view that, I'm sure in 12 months time or 12 months ago, the landscape and what was available for mortgages would have been slightly different.
Indeed. I mean, we've been front page news, haven't we, last couple of years, and we've gone through a very difficult period with rising cost of living. It's been very tough on people, and that's people looking to get on the property ladder, existing landlords, they've really felt the squeeze. And I'm pleased to say that lower mortgage rates over the last 6 months have started to fuel interest in people getting out there and looking to move on with their life, really. So we're really hoping over the next few months that will continue. Certainly looking ahead to August and the next Monetary Policy Committee meeting, we're hoping another cut in the interest rate, which is looking likely will increase that appetite even further. Yeah.
Okay, well, let's sort of, I think as far as today's concerned, it's probably a good idea if we sort of go through the different phases for the sort of people that are looking for mortgages. So we'll touch on first-time buyers because obviously that's a big area, but also, those that are already in the system and what have you. And we'll talk through those stages. But just generally speaking, as an overview, what is the current interest rate and what sort of packages and deals are available, whether that be fixed rate or variable?
Well, until recently, a good interest rate has been 4.5%, but we have noticed in the last few weeks a number of deals creeping under that 4%.
Okay.
And so we're seeing more and more deals sort of starting with a 3, which is what we want. I think that's set to continue over the course of the year.
Yeah.
And you touched on first-time buyers there, David. I mean, we have to look at what alternatives people have. Do they want to still live at home with mum and dad? Do they want to rent somewhere and pay even more money? But in the vast majority of cases, even if people can scrape together a 5% deposit, buying a property and having somewhere of their own will be the most cost effective.
Yeah. Well, let's dive straight in then and let's deal with first time buyers. So I think I wanted to sort of take a step back a little bit because, and you and I have sort of discussed this before, but the sort of 4 criteria that people who don't yet own a property, the 4 boxes that they need to tick, that's how I always explain it to clients. So if we perhaps sort of talk through that, what are the 4 things that clients need in order to buy a property?
Yeah, absolutely. So when I'm introduced to a new client, we'll sit down, we'll have a meeting. We call it a fact find. So I'll obtain lots of information about their situation, and we'll focus in on things like their income, expenditure, affordability, and their credit history. So these are all the key ingredients in working out, can this person get a mortgage in the first place? And can they make the process worthwhile? And there are lots of different components that come together in determining if that person can proceed, and we can then go ahead and get an agreement in principle.
Because at the end of the day, these are the boxes that the lender needs to tick before they will lend the money. So the way I've always explained, and you've just hit all of those 4, as we would expect, because obviously it's your speciality, but a deposit, income, so i.e. a job, good credit history, and affordability.
Affordability has been the most challenging one really over the last couple of years, because every lender will have its own affordability test that a buyer will need to pass. And they won't necessarily base the affordability test on what interest rates are at the moment. But if suddenly interest rates went up by 1 or 2%, those applications are stress tested.
So my understanding of what you just said, just for clarity, is if the interest rate was, say, 4%, they would want to prove to themselves, the lender would want to prove to themselves that the client would still be able to pay if it went up to 6%.
Indeed. And, they will ask for bank statements to make sure that that person's affordability is credible and they're not living in their overdraft like a lot of people are. So my advice to buyers would be to live prudently, certainly in the 3 to 6 months before applying for a mortgage, to make sure, frugally, I should say, to make sure that, there's enough left in the bank account at the end of the day, and they're not living in their overdraft.
So I think this is gold dust, because I think that out of those 4 areas, that's the one that probably people miss. Obviously having an income, well, that's fact. You are paid what you're paid. Your wage slip will support that. You can prove that. Your credit history is an area that people have got some control over, and they need to know what that looks like long before they start looking at properties, really. And that's really what I've been saying to people, is get these 4 boxes ticked, then start looking. Because you would, and I've introduced lots of clients to you that are not ready to buy a property yet, but just to sort of see what that might look like in terms of the client is only really interested in how much can they borrow and how much will it cost. And in their minds, can they afford that?
Yeah, I would agree. And buying a home, particularly your own home, is such an emotive process, isn't it? And how many times I've had people in front of me who've decided they want to buy somewhere. They've been renting for X amount of years, and they've gone on Rightmove, fallen in love with somewhere, and they're already on the IKEA website buying furniture for a place they haven't even viewed yet. You know? So, what I want to try and do is engage with those customers a lot sooner in the process and make sure that they are ticking all their boxes, the affordability and the credit checks, all of those areas have been assessed. And we can go forward and agree a mortgage in principle. We call it an AIP, but this is such an important element in the house buying process, because you're presenting yourself as somebody who's proceedable. And at the moment, where there aren't perhaps so many properties coming on Rightmove, quality properties, you're having a lot of competition there for these properties from, maybe half a dozen different buyers. Somebody who's had a conversation with a mortgage advisor, who's got their agreement in principle, is going to be ahead of in a pecking order against somebody who hasn't.
And that, I think, is where it comes in, where it's so important to, like, if you're thinking about buying a property, then having a conversation with you, other mortgage advisors, do exist, but ticking all 4 of those boxes. And I'm just looking at that, my own sort of notes there, and it seems to me that the one that you have got no or minimal control over is your income. It kind of is what it is. You can do overtime, of course, and things like that. But your pay slip doesn't lie. It's what you receive. If you're self-employed, I suppose you've got a potential a bit more over that. But knowing 3 or 4 months before you start the process that affordability is going to be an issue, stress testing against a higher interest rate, not just against the interest rate that you are working with today, is really, really vital for clients to be aware of.
100%, David. And preparation is key.
Yeah.
And making sure that person that I've got in front of me is in the best position to go forward and make an offer.
Yeah.
And I'm sure other brokers do this. There are lots out there, but actually picking up the phone to the agent and telling the agent that your client is proceedable and good to go.
Yeah.
Just gives them the peace of mind as well that your person is a reliable buyer. And,
well, as we know, I mean, in theory, the estate agents are working for the vendor, so they need to be confident that whoever's being put forward. So actually things like that, a direct conversation with the mortgage broker, as opposed to just a piece of paper that they might get from a high street building society, for example, just sort of, here's my agreement in principle. Yeah. That's going to go a long way to sort of elevating those.
And the agents
clients.
don't want the sellers on their back as well, So if the agent can tell the seller that we've had the broker on the phone and they've given us chapter and verse, this buyer that's viewed and fallen in love with your property is good for the money. That is so valuable and puts everybody's mind at rest.
And also I'm just thinking that those 4 boxes that need to be ticked, that's really still relevant for the second time around purchasers, any purchaser really.
These are all things that can derail an application and shatter somebody's dreams. I do my best to go through each of those and really set an expectation. If there is something that's slightly difficult about somebody's case, it may be that they've had a fall in profits if they're self-employed. It may even be that their profits have shot up in the most recent year. The lender's going to want to know why. Is it a blip? Is it just a one-off? Or can we show something, an income that's more sustainable?
I mean, again, I'm thinking about the affordability, and a tool that I introduce to a lot of my clients is a budget planning tool. And we'll put the link in the video. It's a government-backed, I mean, there are lots of them available, and there are lots available that are free to the consumer. So it's not something you need to pay for, but it is a way of tracking your spending. So the individual client at the end of that process gets a full report summary with a nice pie chart that shows where their money is going, what money is available left over every month. That would be invaluable for the clients to use to be able to prove their affordability to a lender.
Well, there are those cases where things are touch and go. It could go either way on affordability. It's down to the interpretation of the underwriter, isn't it, who's receiving the application, and things can be quite borderline. But if you've got the opportunity, which I have as somebody's broker, to add my own narrative to it and explain that this person can afford this product, that is something that underwriters like the brokers to paint pictures of somebody's situation. So if you've got a client who is pushing their affordability right up to the maximum, this may just tip them over the edge.
Okay. Well, I think this would be invaluable because it will show people in the first instance, the way I use it with people is like, can you afford to put more money into your pension or to clear down some debt, for example, or put more money, start saving into an ISA or whatever it might be. And often people are living, money in, money out. They don't have a lot of disposable income. So to sit down and do this exercise and go through and then sort of think, crikey, we're spending like all this money on subscription television channels, for example, or Deliveroo. Those are the 2 big areas. Or, okay, right, well, it's really important to us to buy a property now. So this is where we can cut back. And if we cut back, then in 3 months' time, the budget planner will show that we've got X amount per month available. Then that report is something that would be really useful for you to then take into the lenders and part of that process.
Yeah, I think if we can help people streamline their outgoings and free up the cash that's going to make them more attractive to a lender, then that's only a good thing.
Yeah. Okay. Well, I think that would be something that would be really useful for clients, to be able to prove their affordability for sure.
I don't know any other brokers using that system at the moment.
Right.
So
okay.
that sounds like a winner.
Yeah, absolutely. So just talk through the practicalities then. So what level of deposit are we currently looking at for first-time buyers?
Anything from as little as 5%.
Okay.
Which is great news. It's still tough getting that 5% deposit, certainly through savings.
Yeah.
We're seeing so many first-time buyers, especially relying on bank and mum and dad to help them in that process.
And that, by the way, is an area that I help a lot with. You know, I have the majority of my clients are quite a lot older. And one of the aspects that I help clients with is, you know, how much is enough for them to live life the way that they want to live. And this is almost like a broken record, really. But the software that I use shows to individuals whether they've got more than enough, nowhere near enough, the money's going to run out, or they've got enough. And actually, if they're in this situation, the way to sort of get to, you know, that they could afford to spend more money or give money away. And therefore, if they just need to get to this level where they've got enough, the money's never going to run out, living the life that they want to live and how they want to lead their life, then that might include giving money to their kids. And most clients that I deal with, they do factor that in to, you know, well, when my son or daughter or my children reach a certain age, we want to be able to help them. So for me to be able to give them the confidence financially that they can afford to do that without impacting too much on their standard of living, that's a really powerful thing. And actually a lot of that will help with their longer term inheritance tax position, for example.
Well, we can bring in the other experts there to help with that inheritance tax liability. And there are measures that people can take to mitigate that.
Absolutely. I have those conversations with people all of the time. So from what I can see, there is real willingness to help children buy their first property.
Absolutely. And there are those parents at the other end of the market who perhaps aren't prepared for their son or daughter to take a step on the ladder. And hey, if you're 55, you can now take out an equity release lifetime mortgage as well.
So there's lots of ways that people can get that deposit. So
there are.
5% is kind of the minimum. The burning question, the one that I get asked a lot, and I'm sure you do as well, fixed or variable interest rates?
Well, at the moment, a fixed rate is what I'm recommending to the majority of clients, only because they might be 0.75 of a percentage point cheaper than a tracker. So we do feel that interest rates will come down, but not necessarily that quickly. And I think what the majority of buyers or borrowers are looking for at the moment is stability in their payments, because the markets have been still very volatile. And to know from 1 month to the next what their payment will be is so important for people right now. And
it's consistency, I think, isn't it? It's that. I was asked this question at the weekend by a friend of mine whose son is looking to buy his first property. You know, surely interest rates are coming down, so why would we go for a fixed rate? And my response to that is, if you know that you can afford it today, then nothing's going to surprise you. And interest rates might come down, but they might go up as well. And at least you know you can afford that. So I've personally been a fan of fixed rates in my sort of mortgage history, but it does seem a little bit counterintuitive when the trend is that the interest rates are coming down, to fix.
Well, I agree, and we're seeing a lot of people fixing for a shorter period at the moment, because the hope is that they'll be able to jump onto a cheaper rate in a couple of years.
So what sort of fixed rates are around? Is a 1 year fixed rate?
There are a few, but the 2 year and the 5
2 year and 5
are usually the main choices.
Okay. And just to give a flavour for where we are right here, right now, bearing in mind it's July 2025, in case someone's watching this video in 3 years' time. Can't imagine that, but who knows. What's the 2 year fixed rate norm at the moment?
Well, that very much depends on the level of deposit. So if you scrape together your 5% deposit, you're going to get a rate around about 5%. That would be a good rate at the moment. There are products now designed for first-time buyers that will offer what we call an income stretch, as well, a more generous affordability for first-time buyers. So the likes of Nationwide, and they have what we call a helping hand mortgage. So they'll actually consider lending up to 6 times somebody's joint income.
Wow.
So it blows everybody else out of the water in terms of affordability. Yes, the monthly payments still have to be right for that person.
Yeah.
But that same lender can also consider a term of up to 40 years. So somebody who's in their mid-20s can have that mortgage right through their
which
working
in
life,
itself will have an impact on
which
the
will
amount,
help keep the payments affordable.
down.
Mm-hmm.
Okay.
But those products, they will rely on you tying yourself in for 5 years. They're 5-year fixed rate products.
Okay, but 5-year fixed, if that's giving you 6 times income compared to the norm, which is what,
4.5,
4.5, then that gets you that little bit more.
Mm-hmm.
Okay,
I mean, that could be huge for somebody. You know, if there's a couple with a child, it could be an extra bedroom, it could be a bit of outside space, it could be nearer the school if that's a priority for people. So that extra boost will help so many people.
Oh, okay, well, that's really interesting and invaluable. Intel into what that looks like. Okay. Well, so a 10% deposit, what does that do to interest
That really
rates?
opens things up, and we've got a much wider choice of lender that we can go to. So you'll find the interest rate will be cheaper, not by much, but maybe 0.25%.
Right.
It's not a big deal for most people. Over a 40-year mortgage, it might save you 50, 60 quid a month.
Right.
But it's more so the choice of lender increases. So if you're self-employed and you've only got 1 year's trade-in history, there are lenders that cater for that who wouldn't necessarily help you if you had just a 5% deposit. So having that extra deposit, the 10%, just reduces the risk from the lender's point of view.
Yeah.
And they're able to be a little bit more keen to do business with more people.
I mean, what I've always said to people is that whatever you do, whoever you speak to, make sure you speak to an independent mortgage advisor. Because if you go to the Nationwide, as good as that deal looks, the 6 times income, they're not going to say, but actually, if you go next door to Santander, their rates are better than ours. They're not going to tell you that, obviously. So going to speak to an independent broker. And also what's striking me just through this conversation is, that everyone's situation is different.
They are. I mean, that Nationwide product might not be right for everybody. So what I'm blessed with as an independent broker is having a plan B for everybody. In fact, a plan C or a plan D on occasion. You know? So it could be, as we've touched on, there may be several areas that could derail an application or somebody's chances of getting on the property ladder. It could be the type of property. So a property with a short lease. It could be, your dream flat, but it's above a shop or a restaurant. These can be issues for lenders and prevent them from lending. And again, it may be a blip on with a credit card payment being missed or a default. So credit history, to a lesser extent, is something that could hamper somebody's chances of getting a mortgage. If they're passing the affordability test and they have a deposit, they're really the main two things that we would encourage people to focus on.
That, I think we've covered first-time buyers, quite comprehensively there. Have we missed anything as far as first-time buyers?
No, you're going to talk about home movers, I hope.
So the next step is that, someone's already a property owner and they want or need to move to get a bigger property, whether it be for schools or just more bedrooms or whatever it might be. So what are the main criteria?
Well, first thing we would do, Dave, is book them in for a chat. And we will try and demystify all the moving costs for people, because this tends to bamboozle people. So we're looking at things like estate agency fees and their commission, what they're going to charge on a sale. It could be the ever-changing stamp duty thresholds.
We'll perhaps come back to stamp duty, because that's a whole different sort of area, really. But we'll come back to that.
Okay. But that certainly is one of the, if not the biggest cost for somebody. There may be early repayment charges on the existing mortgage that they have. If you're 2 years into a 5-year fixed rate, these are all things that need to be taken into account. And ultimately, we want to make sure that people have enough equity from their sale to be able to get on and put down a suitable deposit to buy somewhere new. It may be that people are looking to upsize and getting an extra bedroom because they've got a growing family. So sitting down and having that conversation and exploring what those costs are is absolutely invaluable.
And presumably, ideally, early in the process.
Sooner rather than later, yeah. So even before they've decided to place their property on the market, they want to know that what they're hoping to achieve can actually come to fruition.
Yeah. When they map out what sort of property they're looking for, then they can start to get an idea of what the cost of that is going to be. Then they can see if the finances and the numbers all align.
Yeah, I like round numbers. So if somebody has £100,000 to come out of their property sale, and we can find them enough of a mortgage to make the move happen, the other possibility is that they may need to keep money aside, money back, to carry out essential repairs to that property as well.
Right.
So that's something that we'll talk about too.
And then the other thing that sort of strikes me as well is that, we've got people that are looking to move, existing homeowners that are looking to move. What about those that are not looking to move, but their mortgage term has come to an end? So talk me through what you would do in that situation, how you can help those people.
That really is our busiest area at the moment.
Okay.
So we've got people who've taken out 2-year fixed rates in, 2023.
Yeah.
And those deals are coming to an end. There's still a few deals that people have taken out in 2021 when interest rates were 1.5%.
Yeah.
And those deals are coming up for expiry quite soon. And I was going to say it's going to be a bit of a shock to people, but unless you've had your head buried in the sand, you're going to know from the news that the cost of borrowing is a lot higher than we've had for so many years.
Yeah.
So it's making sure that these people are prepared for that shift.
Yeah.
That jump in their repayments. And we will normally meet 3 or 4 months at least before their fixed rate ends to see how that person's doing.
Yeah.
Make sure all of their income details and expenditure is up to date. Important to understand that their current lender will always give them a new deal regardless of their affordability, which is a huge comfort for people.
Yeah.
But that deal isn't always the best.
So would that just be literally moving from without necessarily going back through the underwriting process at the end of a fixed term that now expires, they simply go on to the variable rate?
Yeah, so if you do nothing and you don't take a new deal with your current lender or a new one, then automatically you'll move to the standard variable rate. Why anyone would want to do that? Because typically they're 7-8%. So that's going to that's going to have a big jump.
Okay.
You're going to see a big jump in your repayment. So we're telling people at the moment to reserve a new deal early because the markets are still volatile. So that could be 3 or 4 months ahead of their current deal ending.
Okay. So what I'm hearing and thinking, particularly anyone who's coming up to the end of a very low fixed rate, is sort of 6 months is probably the not too early to start having those conversations. Certainly 4 months.
Yeah, 6 months, I agree, is a time when we need to be having conversations with our clients about their situation.
Yeah.
And at that stage, I'll be able to determine quite quickly if staying with that same lender is the right thing for that person or if there's a better opportunity with a new lender.
Yeah.
It's so easy now to renew a mortgage deal yourself without the need of a broker. You can actually go onto an app and you'll see a list of deals there.
Yeah.
And you can make, an uninformed decision, but a decision all the same about what deal you want from the 1st of December. But where we add value, I suppose, is that we're able to monitor those rates for the preceding 3 or 4 months and swap that person onto any cheaper deal that's launched.
So in a way, it's no different than someone who's purchasing a property. You want to be looking at the whole of the market, not just the easy option of, in effect, doing nothing and just taking whatever the rate is, or taking an offer that's been made to you by your existing. Because I imagine, do they write to you and say, right, your mortgage's rate is expiring?
They do.
If you do nothing, it's going to be this cost per month, but you could take one of these options, and people would just tick that box and go with that.
Yeah. They do make it very easy for people to renew, but it isn't always the best thing to do.
No, quite. Okay.
There may be occasions, several occasions only in the last few months that somebody has refurbished their property that they bought 2 years ago extensively, and the current lender won't necessarily know that.
Okay.
So the deal that they are presenting to you is based on the original purchase price of the property, rather than the value that all that extra work has increased.
So when there's no underwriting just to automatically go on to the current variable or one of the deals that's been offered, they're not re-underwriting you as an individual, but they're not revaluing the proproperty either, is that right?
No, that's correct. So I can intervene, and if necessary, if it means improving their loan to value, and helping that client get a better deal. It may be they ask me for pictures of the property, the work that's being carried out, whether it's new windows, new bathroom, kitchen, electrics. We can get all of that stuff off to the lender. And they'll be able to reappraise, often free of charge, the value, and help that client move on to a better product.
And presumably the same logic applies as the higher deposit you have as a first-time buyer, the better the lower the rates and the more options you have. It's going to be the same with people that are just staying in their own property. If the loan to value is a lot lower because the value of the property's gone up, then that will help expand the number of deals that are going to be on offer.
That's certainly going to help. Yeah.
Okay. Really interesting stuff here. So my mind's thinking as well, once we've covered sort of people that are either first-time buyers, and then we've looked at people that are already homeowners that are looking either to stay where they are or to move. Some of the other areas just to sort of touch on, people who want to buy a second property as an investment. What does that landscape look like at the moment?
We're seeing a huge increase in the limited company market.
Okay.
So rather than buying a property in your personal name, it can be very tax efficient to buy a property through your own limited company. Yes, you'll still pay the same amount in stamp duty, but if you're a higher rate taxpayer, for example, you wouldn't get really any tax relief on the rental income as a personal owner. But with buying a property through a limited company, you get tax relief on the whole rental income. And that can be a big advantage for somebody.
Okay.
The interest rates may be a bit higher, so I'm telling borrowers to bear that in mind. Often the fees are a bit more expensive, but in the long run, you're going to be better off doing that.
Okay. So that's one of the options now for a buy-to-let purchase. And presumably a lot of the issues that we've just discussed for people that are already buy-to-let owners, where the rates are coming to an end, the same issues exist in terms of reviewing, start looking early to see what options are available to you.
Yeah, the same process applies. So we're reaching out to these people sort of 4 or 5 months before their current rate ends to see how that person is at the moment. And it's important as well to add, David, that the lenders are placing great emphasis now on properties that are energy efficient. Lenders are offering discounts.
Okay.
They're being put under a certain degree of pressure by the government, and the lenders are now the lever in terms of helping people make their properties more energy efficient.
Oh, okay.
So there are certain green targets that the government wants to hit. So, they're entrusting the lenders to help in that process.
Right. Okay.
So the benefit to you, if you've got a property that has an energy rating of A or B, is that you may get discounts on your rates, you may get cash back to help you towards making energy efficient improvements to your home as well.
Oh, right. Okay. Wow. I wasn't aware of that either. I'm not a mortgage broker, so, and that's a lot of what I'm hearing today has been really, really interesting. And
that's the way it's
will
going.
Be to our subscribers on the YouTube channel as well. So, okay. So thanks, James. We've covered a lot of stuff there and some really, really interesting stuff, some real nuggets in that, that I think people will find of real benefit. A lot of my clients whose children are just about to start buying property and so on. So how would you sort of summarize, what sort of feedback, for example, are you getting from the clients that you've been helping over the last sort of few years?
We love feedback, good or bad. And, certainly once one of my customers has picked up their key and moved into their property, we do ask for feedback, of course. And it's interesting to see really that it's rarely the actual interest rate I've recommended that gets all the headlines. It's more about the service and how I've supported people through that journey, because it's a very exciting time, but also very scary time for people, not knowing what to expect, and to have a broker that's going to really hold their hand through that process and explain the process fully and clearly in terms of all the costs involved, being transparent with those and educating people so they know what things are needing to be paid for and when, is where we get most of our recognition as a company. So that's really great to hear. It's giving peace of mind to those people.
Okay, excellent. Okay, well, I mean, it's been really, really invaluable. So thank you for your time.
Okay,
Good to see you.
Good to see you.
All right, cheers.